So let's try and make a very boring topic interesting because it's important. Okay, products, what to buy, what to invest in. So most people want to buy shares because shares is the thing that gives you long-term growth. Agreed. But not everybody has 10 million rand to buy a whole portfolio of shares. And that's basically what you need because there are different sectors on the stock exchange. You need to first pick the sector. And then inside the sector, there are dozens of shares that you can pick from. And which one do you pick? So you need a combination. And for that, you need a lot of money. And not everybody's millionaires. Okay. So a unit trust is the alternative. You can buy multiple amounts of shares without having to pay the actual share price and buying a whole lot of one share in order to make money over a term. So it works like this. There's a trust and you buy a specific unit in that trust at a certain price. So say you want to buy an equity fund, you can buy a cash fund or a multi-asset fund or a property fund or whatever you want to buy, or a combination of all of the above. You have a fund manager. The fund manager decides what they want to buy, when they want to buy it, how long they want to keep it for, when they want to sell it. All you do is you give them your money, your small amount, once off or on a regular basis, depending on which provider you chose, the platform that you're choosing to get this unit trust from. And then in that specific trust, you will have a specific price connected to the unit in that trust. You buy a certain amount of units for the amount that you invest, and ta-da, you get your dividends or your interest returns based proportionally on the unit you own inside that trust. That's a unit trust. Most of the things are directly linked to unit trust these days. Okay, so unit trust in itself is taxable. The growth in it is taxable. Yes, you get rebates and exemptions and all of those things, but it's taxable. And when you draw the money, it's like you've realized a share or sold an asset, and therefore you will pay capital gains tax on it. So you can put a jacket on this unit trust that will make it a little bit more tax friendly. One of the jackets is a tax-free savings account. Tax-free savings account jacket means that you're immediately limited to the list of unit trusts you can pick because they have rules around the fees that they're allowed to charge. Okay, but yes, if you can find the thing you're looking for to invest in and you're happy with the annual limits and the lifetime limits and the rules around the tax-free savings account, it means that everything inside of that unit trust with that jacket on is tax-free. No capital gains tax, no interest tax, no dividends tax, no tax. Good way to save. Then there's the retirement annuity jacket. Now you got the unit trust, you put the retirement annuity jacket on it. It means immediately that you are restricted as to how you can invest it because now it must comply with the regulations of the Pension Funds Act because of the retirement annuity jacket. But because of that jacket, everything you put inside of that retirement annuity unit trust is deductible from tax up to certain limits before your income tax is calculated. So very tax friendly. But yes, you are restricted according to regulation 28 of how much money you can put offshore, how much money you can put in equity. But that's all built in to protect you over the long term for retirement purposes. So that's the other jacket. Then there is a policy wrapper called an endowment. The moment you put that jacket on, it means it's no longer in your hands. It's in the name of a company, the company that you buy it from. It's taxed inside that company, and therefore it's not taxed at natural person rates, which means if you fall in a high tax bracket, you can score from a tax perspective because inside that policy wrapper, it might be taxed at a lower rate. And when you receive the money someday, once the policy matures, it is received after tax or kind of tax-free. Okay, so you usually buy a capital guarantee with it. Sometimes that's included, and it can become quite expensive, so you must be careful which platform you choose. And I don't want to get too technical because you also get a sinking fund which hasn't got a life assured, and then an endowment has a life assured. But because it's a policy, the point I'm trying to make is that it's tax friendly if your tax rate as an individual is higher than the tax rate that is paid inside that policy. Because after the restricted term, yes, there's a restricted term, you can't touch the money, with one surrender, one loan, one withdrawal, depending on which company you buy it from, by the way, because the rules aren't all exactly the same. But yeah, there's a 5-year minimum restricted period, which means during that term, you can't draw all the money from that policy. You can only get the money at the end of the term. Okay, so if you're happy with that, if that's the kind of structure you want, and you've compared the fees and you've looked at the taxes, this could be a very nice jacket for your policy wrapper to wear. Okay. Then the last one I want to talk about is ETFs, exchange traded funds. They're also just normal unit trusts like when we started off with. It's not really a jacket. The only difference here is that you are tracking a specific index. So it's passively managed. It means it's slightly cheaper because there's no active manager deciding what we're going to buy, what we're going to sell. Because you pick an ETF in a certain sector, say for instance, just as an example, a property sector, and it will track the property index. So it's got lower fees, but it could be high transaction costs depending on where you buy it from or what platform you use. But yeah, you're just tracking an index. You just have to choose the index you want to track, and then that investment does whatever the average of that index would have been. Sometimes they tweak it a little bit, whoever you buy it from, so that they'll exclude certain properties, for instance, or certain portions of the market, or they'll equally weight it instead of going according to market cap. So yeah, you just have to find out what it is. But it's passively managed versus a unit trust where it is actively managed by a fund manager who decides what to buy, when to buy it, when to sell it. And that, in a nutshell, is a summary of products. And here follows a few questions you can ask yourself that will help you towards which product you should use for the goal that you intended.